Hey, what it do, world? Welcome to the Market Banter podcast. This is the People's Financial Show, the People's Podcast. Thank you, Dan. Dan just threw up a fist for the people. You're rolling with me. I am Dion Rabowen. I am a financial and business journalist. I write the Axios Markets newsletter. You also got Dan Enfield. He is a New York City comedian and working stiff extraordinaire. Together we make up this show we call Market Banter, where we give the people what they want, give the people what they need, which is a little bit of explanation, a little bit of real market insight. And we also talk to some of the smartest people in the biz. Today we have a pretty fantastic guest. I'm excited for you all to hear from him. Corey Hoffstein, he is the co-founder and CIO of Newfound Research, dropping some knowledge on us about some investment techniques, his take on the market, central banks, inflation, all that good stuff. So we'll be getting into things with Corey just in a second. Dan, how are you doing over there? How's New York treating you?
Doing great, man. It's bitterly cold, and it's going to get another foot of snow here tomorrow, it looks like. So, or half a foot, I should say. Maybe like half a foot, who knows? Someone accused me of being a weather alarmist recently, so I don't want to be a weather alarmist.
Yeah, I mean, if you're taking half a foot and turning it into a foot, you are being a weather alarmist.
Well, I think all the weather forecasts now, I feel like back in the day, they used to all be very different. Like, there were, like, different models you could subscribe to. Now they're all kind of the same. So if you, like, slip up and say something that wasn't in a model, people just go nuts. They're like, I didn't hear this. People just, like, I don't know. It's really funny. So
right. Yeah, it's a bit like the markets, like people who are outside kind of the consensus norm.
Right.
Really get a little ostracized, people get a little upset.
People go nuts now, so it's
they do.
Crazy.
They go a little nuts.
But really now, I mean, with COVID, I mean, no one's commuting really right now. So like, weather schmether, I mean, if it snows, it doesn't. I mean, I'm not braving it in my commute anymore right now. So who cares?
Right. Yeah. I'm in Phoenix, so who cares?
There you go.
There is no weather here. There's only
no
sunshine.
Weather. Right.
And cold nights. Anyway, that's a perfect segue. Let's get right into Corey. He, like I said, is the co-founder, the CIO, Newfound Research. We've got him here on Market Banter, dropping knowledge. So let's get right into our interview with Corey Hoffstein. All right. Welcoming in now our special guest. He's not just good looking. He is a brilliant guy, an investor. He's gonna talk to us about what's really going on in the markets right now, and I'm excited to have him on because there's a lot of craziness. And I think some of the things I've watched a couple of your interviews, and you really talk about sticking to a thesis and sticking to a method. And so I'm really excited right now to have Corey on. We've got Corey Hoffstein. He is the co-founder and chief investment officer at Newfound Research. Corey, what's going on, man? Thanks for joining us on Market Banter.
Dion, Dan, pleasure to be here. Thank you for that warm intro. Nothing better than just buttering up your guest right from the get-go. I mean,
yeah.
Now I'm invested. Now I want to be here.
Exactly. now you want to be here. You want to give us the best show possible. Everything is going to go great now.
Absolutely. No, but thank you again. I appreciate the opportunity.
No, man. We're really glad to have you. Talk to us a little bit about first, what is Newfound Research? I gave them a little bit of backstory about what you do, but talk a little bit about what you do and how Newfound is different than other firms out there.
Yeah, so Newfound Research, we originally got our start as a research firm, hence the name Newfound Research. Around 2013, pivoted into a more traditional asset manager. So today I would describe the firm as a quantitative asset management firm that's really trying to help investors proactively navigate market risk, not only through thought leadership, but investment acumen. When it comes to the actual process of how we go about trying to achieve that risk management, our core focus is really on diversification, but not the traditional diversification of just what you're invested in, but a more holistic view of diversification, what you're invested in, how you're making those investment decisions, and even when you're making those investment decisions. And we think those three axes together really cover a more holistic scope of what it means to be a well-diversified portfolio.
What do you think about what central banks are doing and what they're going to be doing in the future?
So I think my position on central banks has dramatically changed in the last year. Exiting the March 2020 crisis, I did a deep introspection on our own investment policies and how I thought the market was operating. And my view at this point is that central banks, not just central banks anymore, but governments as well, have moved from referees to really active participants in the market. And I think one of the impacts that they are having, which is potentially systemically dangerous for markets, is that by constantly acting as support in the markets and suppressing volatility and suppressing interest rates, they've taken away treasuries as a savings vehicle for investors.
That's what they've been historically, though, right?
Yeah, exactly. So if you, for example, wanted to achieve a 7.5% return historically, back in 1995, you could have held 100% U.S. treasuries. In, call it 2005, it would have had to have been a portfolio that was about 50% stocks, 50% bonds. In 2015 or 2020, you probably need a portfolio that's 90% stocks, 10% bonds. I would guess that probably neither of you have a whole lot in a savings account. I don't know many people our age that have money in savings account, because savings accounts don't give you anything. You might have a checking account just for spending money, but what has happened is
It's all in the 401k.
It's all in the 401k, that the market has become a savings vehicle. So what does that mean? Well, if the market is a savings vehicle, what ultimately ends up happening is the market and the economy become inextricably linked via the wealth effect. That as the market becomes more volatile, consumer savings becomes more volatile.
Right.
Consumers feel more at risk, and so they stop spending. And so all of a sudden it has this pro-cyclical impact. And then
the government kind of feels like they have a hand in it now too. They got to keep the stock market going up, et cetera, et cetera.
Exactly.
Yeah, right.
So
I actually agree with that. That's actually a great point.
Can central banks extract themselves from markets? I think it's very difficult to do quickly unless you have a very strong economy. Otherwise, they have to sort of slowly peel themselves away. But we're in a market environment that unless we get rates back to 5-6%, and I don't know if that's going to ever happen again unless inflation starts running much higher.
Again either.
Right? I don't know if people are going to stop using the market as a savings vehicle. And so I think we're in a very different environment today than we were 20 or 30 years ago.
Yeah, well, that's a great point.
So the market as a savings vehicle, that's an interesting idea, because the market's not meant to be a savings vehicle, right? Like, one of the first things I feel like investment advisors and financial professionals and all of them always tell you is, don't ever put more in the market than you can lose. And I don't think anyone would tell you that about a savings account.
Well, I think what happened, I would ask you guys how you sort of came into the market, but I know for me, it's always been stocks for the long run, right? That if you want to grow your wealth, you need to start saving and systematically investing and dollar cost averaging. And if your horizon is 30, 40 years, you just invest, as much capital as you can safely afford to invest. And then as you get to that point in your life where you want to start withdrawing, where you begin to encounter sequence of return risk, you start to de-risk that portfolio and go from maybe a stock-heavy portfolio into a bond-heavy portfolio. That sort of MO of stocks for the long run is not true in every country. It's really true in the United States, but the U.S. has been an exceptional outlier. And so it's hard to ask whether the lessons we've learned in the United States are the correct lessons. You can consider that the last generation of investors, the baby boomers, really started investing at a perfect point. Most of them grew a material part of their wealth, started earning a lot in the 1980s. And the 1980s through the 2000s were one of the best returning periods for bonds and equities ever. So when you think about when most millennials maybe started saving or investing, I know I came into the market, I graduated from college in 2009. Now, yeah, you could say the last 10 years have been phenomenal for equity returns, but if you started in 2000 to 2009, it was a lost decade. There was lots of economic turbulence. So it's hard to sort of ask the question of what are the lessons we've learned about savings and using the markets as a savings vehicle, and try to extract that from the prior generation's experience with markets.
Okay. So let me step back a little bit and ask you this. Where do you think, or what asset classes are you most excited about, or do you feel like are going to provide the best returns going forward right now?
So I mentioned that after March 2020, I sort of went through this introspection period. I came out the other side and I published a paper called Liquidity Cascades. And it's all about all these different pressures that occur in the marketplace that are making the market more extreme in both directions, right?
Yeah,
so
that
we
sounds
often
like a rap
think of the tails of the market as being the left tail, sort of the crisis, but there's also the right tail, right? That markets can melt up. You can be in a bubble. You could be 1998 and you could party all the way to 2000. You don't want to miss that right tail either. But it seems that market forces are existing in a way where we're getting more extremes to both the left and the right tail. So for me, what I'm very bullish on structurally right now is trying to build convexity into your portfolio. So what do I mean by that? Well,
I was just going to ask you.
Convexity. Yep. So what do I mean by that? Most portfolios are very linearly constructed. They hold, say your average allocator holds stocks and bonds. If stocks go up $1, your stocks go up $1, right? Convex instruments mean that they appreciate at an accelerating rate. So for example, if stocks go up $1, your convex instrument might go up $1. If stocks go up $2, your convex instrument might go up $2.10. Stocks go up $5, your convex instrument might go up $10, right? So a good example of a convex instrument might be a lottery ticket. You pay a little bit of money, that's your premium, and there's a big potential outsized return. On the downside, when you're looking for protection, stocks go down a little. Well, you might want to say, I want to protect a little. Stocks go down a lot, you might want to protect a whole lot. So this would be like insurance. You pay a little premium, and then if there's some big catastrophe, you get a really big payout. That's sort of a convex payout. So what is this in markets, right? And why is it important? Well, if I'm right, and my thesis is that markets are seeing extremes with greater frequency, then managing those extremes is really hard with just a linear portfolio. What you probably want, and the way we've gone about structuring our portfolios, is saying, yeah, we want to build around a core of stocks and bonds, but we want to buy some out-of-the-money call options on equities so that if markets really run, we get some upside leverage and some outsized participation. And then we also want some out-of-the-money put options so that if the market sells off, those put options can act like a little bit of insurance, right? We're paying a little bit of premium.
You mean like
and
a
then
short? Is that what you're saying? Like a short?
Yeah. So a put option, right? Basically what happens is when you buy a put option, you have basically the right to sell your security to someone at a certain price. And so as the market sells off more, you're basically saying, okay, I have the right to sell my stocks to you at $80. They're at $40. Guess what? You got to pay me $80. So you're sort of drawing a line in the sand where the protection is. It's a little bit more complicated than that with all the mechanisms that go on and how these things get priced. But the basic idea is you're almost buying insurance for your portfolio. You're going to pay a little bit of a premium, and if the market goes down, you're going to get a big payout.
How much of a portfolio would you say that should be? Those instruments, calls and puts.
Yeah, so what's interesting is there's a lot of embedded leverage in calls and puts. And so you can pay, for example, the way we do it is a little, fixed amount each year. I can spend, 2% of my portfolio in buying these lottery ticket type exposures, and I can spend 2% of my portfolio buying this insurance type structure. And if I'm entirely wrong and those don't pay off at all, then I basically lose 4% of my portfolio. But let's say I'm right on the upside. Well, that 2% could turn into 10%, right? It can grow massively. Similarly, on the downside, if the market sells off, that 2% protection can all of a sudden go up and become 10%. So as my equities are selling off, this asset's actually providing a bit of a cushion and something that I can sell to then use to buy stocks when they've been sold off. So it's hard to recommend.
Kind of like a hedge, basically. No,
exactly. We're trying to hedge both the left and the right tail from a structural perspective. I cannot recommend to anyone what the right size is, right? I don't know, but I can tell you the way we do it, we're looking to have a very fixed spend so that we know exactly how much we're spending on hedging both the left and the right tail in the premium that we spend, so that if we're wrong, which we expect to be wrong from time to time, we're not, spending more than we'd want to.
Right. Would you call yourself risk averse?
I would say that we are risk averse, but I think there's another side of risk aversion, which is failing to participate meaningfully with equity market growth. I think, again, everyone focuses on the left tail. From an allocator's perspective, failing to participate in a bubble can be a risk as well. That if this bubble continues to go and tech stocks keep running and you're just a stodgy old allocator buying value stocks because that's what worked in the dot-com crisis and you're expecting that again, well, you could be sitting on your hands for 2 or 3 years depending on how this market unfolds. So I look at it as saying, yes, I'm risk averse, but I need to be able to participate with that growth.
You also want to get going while the going's good.
Exactly. That participation in itself is somewhat a risk averse decision, though.
Right.
But Corey, would you say that we're in a bubble right now? Would you call this a bubble?
It's hard. I think it's much easier, obviously, in hindsight, to call something a bubble. I look at a couple of factors here, right? If we look at call option volume on individual stocks and what's called sort of what we would assume would be retail order flow. So small lots. These aren't big institutional trades. These are, smaller lots. That is at all-time highs in terms of volume. So we're seeing more speculative betting with call options than we ever have. Yeah. If we look at volume in penny stocks on the OTC exchange, it is highest volume by far and away we've ever seen. If we look at the growth of sort of what we would call junky stocks, I mean, it's a bunch of basket of retail favorite stocks that are massively overpriced, unprofitable tech companies. They have gone ballistic in the last year. I think it's hard to say we're not in some sort of speculative mania. Mania might be too strong a word, but I'm hesitant to call it a bubble because bubbles can certainly keep going for 2 or 3 years. So I don't want to call it a bubble here and have it keep going for another 2 years when it would have been better at the end of 2 years to call it a bubble. But I certainly think we are seeing a very frothy market from a speculative perspective.
We're in a very, very long bubble.
Exactly. This could keep going. I think people forget that when you go back to 1998, there were people calling for a bubble in 98, 97, 99, and they were right, but early and therefore wrong. And so it's important to I think all of us look back at 99 and we go, we know the lesson here, right? We know that this can't last. And so everyone's kind of trying to position themselves for the fallout. But in doing so, they can actually delay when the bubble gets popped because fewer and fewer people are chasing the bubble. So if all these institutions are going, no, we're not going to get caught off sides again, well, that means they're not capitulating, which means the bubble isn't going to accelerate as fast, which means this could drag out for years. Entirely possible. Or you could just see all of a sudden a bunch of retail participants owe some taxes, they stop speculating, and the whole thing deflates on its own.
And the other thing that I say to people who compare this to 99, 2000 is that we didn't have the Fed in 99, 2000, as you described it, as an active participant on the field. And the Fed can just create money. So it's not just that you have an active participant on the field. You have an active participant that's like, it's a combination Junior Seau, Lawrence Taylor out there on steroids that can't be stopped. So that's the participant you're dealing with. Corey, before we wrap up,
and the government with fiscal policy as well. I don't want to overlook fiscal policy.
Well, yeah, and the government, I think, is being backed up as well because as they're creating more of this debt, the Fed's just buying it, monetizing it. And so there's, incentive to print even more. Last question I want to ask you is just about Bitcoin. How is someone like you looking at Bitcoin? Because I know you got to be getting questions about it as it goes up and up and up.
Yeah.
As it goes up and up and up, I know you got to have questions.
We fielded a lot of questions back in 2017. I almost get no questions about it now.
Really? That's interesting.
Yeah, from an allocator's perspective,
say it's bullshit, man. Come on, come out with
it. From a professional, I will say, from a professional investor's perspective, it's nearly impossible to allocate to Bitcoin. Like in my position, I couldn't even buy Bitcoin for my clients, for my fund if I wanted to. So
Why?
just some
Because it's so expensive, or because
no, by prospectus, I can't buy it in my fund. There's rules that sort of lay out what I can and cannot do.
right?
But even if I wanted to buy it, I need somewhere to custody it. And there's nowhere I could actually custody those assets. There's the SEC would prohibit me from buying it, basically.
That because Bitcoin doesn't really live anywhere. Is that why? Is that it, or no? Is it?
No, the SEC just basically is uncomfortable with Bitcoin. That's why you haven't seen a Bitcoin fund get launched in the
Right.
US
No
yet.
Bitcoin
Because the
ETF.
SEC,
But you could-
as they should be.
so
you
let me-
could get some Bitcoin futures on the CME. Invest in
you
that.
could. Yep. So let me tell you my perspective. So I can't because I don't have the right within my fund to buy Bitcoin futures. I could though change my prospectus and do that in the future. My thought is I had a friend I think put it best who said there's truth and there's being right. And I think a lot of us have focused on trying to find the truth behind Bitcoin. Is this something that is valuable? Is it not? What's its utility? And I think having the truth doesn't necessarily make you money in markets. It's this Keynesian beauty contest that if other people are going to find value in it, the price can go up. Another way I'm sort of looking at it nowadays is there another example in history where so much brain power has been put towards a problem that nothing comes out of it at the end of the day? Right? There's so many computer science students that are moving towards the crypto space. There's so much being built in that space. I find it hard to believe that there isn't going to be a change in the way that finance works going forward, how the world economy works going forward, that won't somehow be influenced by crypto. I don't know the role that Bitcoin will play, though.
Yeah, that's what that's what I've said all along. Like, I think blockchain and stuff like that is legit. I mean, there's definitely like legit.
Is that what
principles.
you've said this whole time,
I
Dan?
have said that. I have said that. I have said that.
I don't know that you have. I don't know that you have.
I'm saying there's like legit principles. I just watched another documentary on Bitcoin, and I left even more confused than I was going in. But separate point.
So
But I think you could basically just apply a lot of these crypto principles with the American dollar. You don't. It's not. You could have one without the other. That's what people don't get, in my opinion.
I had a conversation this morning with a friend who said we all think about the left tails all the time, how we can hedge the downside, but we don't spend a lot of time thinking about the fun right tails. If you took, I don't know, half of 1% of your portfolio and started buying Bitcoin 5 years ago, just for the idea of, hey, this could turn into a fun speculative mania that could go up 10 times, that could actually make a change in your returns if that right tail happens. But if you lost half of 1% of your portfolio on a speculative bet that went to zero, it's not the end of the world for most people. And so I think the idea here is, right, Dan, you're searching for truth the way I've been searching for truth, trying
That's
to say...
I'm a truther. Dion,
and you and I have both missed out on being right.
Right.
And you've missed out on getting paid with these Bitcoin
Exactly.
billions.
You say getting right, that's what you mean, getting paid, basically.
Yeah, exactly.
Being balling out. Corey Hoffstein, he is the
great.
co-founder and CIO of Newfound Research. Thank you so much, Corey, for being with us on Market Banter.
Dan, Dion, thank you for having me.
All right, so yeah, that was Corey Hoffstein, CIO, Chief Investment Officer, and co-founder Newfound Research. And I think
guy.
was really... he is a smart guy. You know, he didn't wear his glasses for us, which was a shame. It always makes me sad when I'm the only guy wearing glasses. But I guess
It's because you weren't. It's because you weren't debating him. You have to take the glasses off and then put the glasses back on.
Sir. Yeah, he's in Grand Cayman. He's down in Grand Cayman. Took the family down there. Right?
It's crazy.
I wish I
talk
thought
about a humble brag, right?
Yeah. Took the family down to Grand Cayman.
Yeah, I was expecting him to
What's
say
that?
Itasca, Illinois, or something, and then he.
Why? Why would he be in Itasca, Illinois?
I don't know. I was expecting him to say, Schaumburg or something like that. He just drops.
Why? Why would he go to these places? What are you talking about?
I don't know. I was expecting him to say some random town where his aunt lives or something. Instead, he's just dropping the Grand Cayman reference. I just was not expecting that.
I've been to Grand Cayman one time. I went to play a rugby tournament, so I don't really know what it's like, but it's not as luxurious. But maybe we were just not in the luxurious parts. I don't know, but it just kind of seemed like it reminded me kind of what I imagine Guam would be like.
Okay.
Or just like some other non-glamorous, non-luxurious island. It's just kind of a place.
Yeah, I
But
had a friend who
like I
couldn't
said,
get into
also
medical.
though,
I had a friend who couldn't get into medical school in America, so he had to go to like Barbados or something. But he said it was actually great because he said there was literally nothing going on, so all you could do was study. It wasn't what you thought, basically. You
I guess your friend doesn't like the beach. I would assume there's lots of
know,
beach in Barbados. It's not his thing. Whatever.
not his thing. Yeah,
Um, Nah, but like in Grand Cayman, I will say there were the only I forgot to pack flip flops, and so I went to this store to buy flip flops. The cheapest flip flops I could find were $65, and I was like, oh, okay, this is where I am. Got
were you
it.
shopping at like Louis Vuitton on the beach or what? Where
No, no,
were
no,
you?
no, no. This is like the local. This is like the local store. You know what I
Huh?
mean?
Wow.
Yeah. And these were the. So I just had to. I just didn't have flip flops the whole vacation because I was like, I'm not. I will not pay $65 for flip flops. Won't do it. Will
That's how
not.
I am with umbrellas now. Like I've spent so much money in my life on umbrellas. If I don't have one and it's raining, I'm like, I'm getting wet. I just don't care. I've spent so much on umbrellas and it's just like no more. When I first moved to New
Yeah.
York, it was like something out of a movie. I stupidly bought from one of those guys on the street when it was raining. And it was like just like a comedy movie. I opened the umbrella and it exploded on me right after I bought it. I was like, you gotta be kidding me. It was crazy.
And I bet it cost you like
I
$25,
think I spent like
right?
25 bucks on it. I still kick myself for
That's great.
Yeah,
So
yeah.
that's actually a great segue to the GameStop hearings that we had today
Ooh.
because the lawmakers presiding over the hearings were, I think, similarly clueless. But I will say this: what I found really interesting because there was a lot of criticism about the hearings from the finance crowd, FinTwit as it's called. If you're cool and in the know like I am,
Fin Twit?
FinTwit, FinTwit, yeah, finance Twitter.
Okay, okay.
Um, it was people were really dogging the House representatives because they weren't asking substantive questions, but like the thing is the substantive questions that need to be asked no one really understands anyways. There's no point in having a hearing on it. The whole point of this hearing is just to be like, hey, did you cheat? And then they'll be like, no, and they'll be like, okay, you're on the record as saying you didn't cheat, so if you cheated, we're gonna get you.
Right.
That's kind of the whole point of things like this. And I'm not really sure what the larger point of it was in terms of like what they were actually trying to figure out. I figured they were going to go after the hedge funds, but it seemed like for most of the hearing they were going after Vlad Tenev, who's the CEO of Robinhood. And I've been saying for years that Robinhood is trash and no one should use Robinhood.
By the way, I've known you for years. I will vouch for you on this. You were early. You were early
Yeah,
on the Robin Hood hate.
I was early. I was telling people that Robinhood is trash, and if you have Robinhood, you should get rid of Robinhood. And Maxine Waters, the chair of the committee, love her or hate her, she's entertaining. Um, she really just laid out the case. She's like, "You're screwing your customers on trades, order flow. They've
Hmm.
lost money every time that your site has gone out."
Hmm.
And it just like goes down the line of like, here's why Robinhood is
Hmm.
terrible.
Now,
So I don't know
let
if
me ask you
you,
a stupid question. Like, why don't people use
yeah,
E-Trade? It's the same. It's a comparable service.
I
I mean, is there?
I don't know.
Okay.
It's like it's kind
What's
of
the
like the
appeal of
same
Robinhood? Is
reason.
it the free trades they give you or stuff? Or I mean, what exactly is
No,
it?
Robinhood is just cool. It's just the thing that like when you're when you don't really know anything about trading and you want to start trading, you're like, oh, I should download Robinhood
Okay.
rather than I should download E Trade. They've just somehow to people like us have become the place, or even younger people like people in
Hmm.
their 20s, they associate trading with Robinhood, which is
Hmm.
stupid and they shouldn't, but they do because Robinhood has been really great at marketing themselves
Okay.
as like, oh, you're not a Wall Street pro, you need Robinhood, don't go
Right.
with any of those guys.
Okay. Okay.
So it's
So it's
yeah,
so it's like a WeWork. It's like a WeWork. It's an old idea that was repackaged for young people, basically. Or
yes,
not.
sort of, more or less.
I
It's
mean,
just like,
like
yeah,
there's,
they
there's
just
nothing groundbreaking about what they do. Basically, it's same as each. Say it functions the same way as any online trading platform.
Yeah, and what was funny was the CEO actually was really clear or clever in parsing his words because they weren't the first to offer free trades and they weren't the first to offer partial trades like God, what's the word for it? Where you can buy a portion or you can buy like a portion of the stock. So you
Oh,
can
I
buy
didn't
like
know that.
ten
You can do that.
dollars fractional shares. What's
Fractional
that?
shares. I didn't know you could do that. Wow.
Yeah. Yeah, where you can buy fractional shares. They weren't the first to offer fractional shares. They weren't the first to offer free trading. So he kept saying like we were the first to bring this to the masses, or we were the first to popularize this, or things like that, because they weren't actually the first. They don't do it the best. They just got really popular with a big advertising campaign. And they've raised billions more dollars as this has gone on from investors, and they've actually had a bunch more signups because people are idiots. So yeah, that's where we are. And I'm
Mm,
it's going to be really interesting to see what happens to Robinhood after, again, the case was made very clearly by the chairwoman of the Financial Services Committee that this
mm,
service is trash and no one should
mm.
use it, but I feel like that's been very clear for years now and people keep signing up for Robinhood. So, what do I know?
What do I? Yeah, exactly. Yeah.
What do I
What do
know?
you know?
Anyway,
What does anybody know?
what's that?
Yeah. What does anybody know? But we all just
What does
listen to
anybody
Dion,
know?
man. We wouldn't have been in this mess.
Exactly. Exactly. Although I sometimes feel like you about crypto, like maybe I'm just a hater.
Yeah. Yeah. Right. Right. Right.
Maybe I'm just a hater. Maybe that's the problem.
That's like the best thing.
And
That's like the worst thing about the internet is that, like, 30 years ago you could hate something and then just, change and not tell anybody. Now it's like it's all memorialized.
yeah, no, like wait a second, I have this footage of you where you said it's like, yeah, that's right.
Yeah. Yeah.
That's right. Keeps you honest though. Anyway, that's gonna do it for market banter today. We only had the one subject to go over. Dan, any announcements you want to make?
Not much, man. Just here in New York, hoping things get rolling here soon. I could be going to a Knick game. I'm in the lotto for Knicks tickets where they're opening up MSG
Ooh,
in a few weeks. So
look at
I'll
you.
maybe we'll do the next show live from MSG. If they let us back.
Yeah. I really was disappointed when the Nets got KD and Kyrie, and now they have Harden, because the Brooklyn Nets games were how I went to see basketball when I lived in New York. It was
Right.
like I would, because they were cheap. Like the Knicks,
Cheap.
no matter how terrible they are, will charge
The
absolutely
ticket
ridiculous
prices
premium
never go
prices.
down, no matter how bad they are. They
Never.
never go down, which
Yeah.
is crazy.
They're
So true.
absolutely awful, but they will continue to charge premium pricing. So I just refuse. And I would always go to the Nets, but now the Nets have three all-stars, three
Ugh.
like perennial all NBA players, and what am I gonna do?
Yeah.
Anyway, that's it for Market Banter. What a way to end the show. This has been the
Yeah.
People's Financial Show. Thank you for tuning in. Thanks to our guest, Corey Hoffstein, Newfound Research. Dan, thanks to you. And thanks
Oh
everybody for
wow.
listening.
And thank you.